You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Welcome to OIC's Wide World of Options. Thanks for joining us for today's show. Let's get started with industry happenings.
It's time to get a handle on the latest developments from the world of options. It's time for Industry Happenings.
In today's industry happenings, we're going to respond to a couple of listener questions. Brian Ortega asks, I've heard several option experts advise against selling cash-secured puts as a way to get long stock. They kept referring to the gap risk of the position. But didn't May 6th and August 24th in the last few years teach us that there is a gap risk associated with working a simple limit stock order? If so, aren't I always better off writing the put and collecting the income versus working a limit order but receiving no compensation for my risk? Well, Brian, thanks for the question. And my response would be different experts, as you refer to them, have different opinions. Gap risk is always a possibility for any long position. I agree with you that I'd rather collect income while waiting for my stock to retreat to my buy level rather than placing a limit order that may or may not be triggered and most certainly will not generate income while we wait. Our second question comes from Alex Rosa. Alex asks, can you discuss pin risk and open interest? First of all, pin risk is when a stock, index, or ETF at expiration settles right at the strike. With all the different prices out there, you'd think that wouldn't happen too often, but try having long option positions at the strike while the stock is expiring. It's very painful as all the premium comes out of those options. Where strike prices and open interest cross paths has to do with the amount of open interest in a particular strike. The greater the open interest, the greater the probability the underlying will be driven toward the strike, as long option holders trade the underlying around their long strike gamma, often pinning the underlying near the strike. The idea is the larger the strike open interest, the more likely the stock may get pinned to that strike. That's how it works with open interest and strikes. The greater the open interest in that particular strike, the more likely the probability that that stock may get pinned. So thanks to Brian and Alex for their questions today. Keep them coming. That's today's industry happenings.
It's time to break down the latest option strategies. It's time for Strategy Spotlight.
Joining us today on Strategy Spotlight is Andrew Giovinazzi of OptionPit.com. Andrew is the Chief Operating Officer at OptionPit. He's also the risk manager at their hedge fund, Carmen Line Capital. Andrew, welcome.
It is great to be here, Mr. Joe, who I've known now for quite a while.
Yeah,
8 years. 8 years.
We do go back a while. Now, did I butcher your last name as I usually do?
It wasn't too bad this time. It's just Giovinazzi, just like a straight, it's just a straight Italian version. You don't have to throw any extra vowels in it. I already have enough vowels.
Well, I can't help myself. Anyway, thank you so much for joining us. It'd be great to share your expertise with our listeners in these volatile markets. Before we start talking risk management and strategies, why don't you let our listeners, those of you who aren't familiar with you, tell them a little bit about yourself.
Sure. I was a SIBO market maker and a PCX market maker for 15 years. Basically, I started in the late 80s and basically stopped trading. I was trading with a friend for about 5 or 6 years, and we just kind of decided to call it quits, mostly because I needed to take a break. And but we had a good, ended up being Henry Capital. We had a small little option trading firm, and then I just went on to do other stuff. Tried to start a financial technology software, not start the company, but I was working for a startup for several years, it's still going. And now I met Mark Sebastian, started Option Pit, trying to use sort of market maker vol trading techniques, and teach them to retail traders. And he was also at Group One, and I traded there for 10 years as a market maker at DPM in Chicago. And when I left Group One, he actually had just gotten out of college and started. So he took kind of the training program, or volatility trading anyway, and he started to educate retail option traders on it. And then I joined him, I guess, 4.5 years ago now. So mostly what we do now is just, we run a live chat room, and we look at trades, portfolio management, risk management during the day, see what looks interesting, and we just educate people on how options work, how vol traders run a volatility book, and and essentially that's where we are. And we've had plenty of volatility lately, so there has been plenty to talk about. Let's just say that.
Indeed, and this segment, as I mentioned, is Strategy Spotlight. So you touched on a lot of really excellent points there, between vol trading to risk management. At OIC this year, we're focusing each month on a particular educational theme, and this month's theme is risk management. So if you would, you're basically working also as a risk manager for the new hedge fund. Talk to me about your philosophy, if you would, of risk management, maybe at a very high level.
The basic philosophy is contract count, net contracts. So you don't want positions where if you wake up the next morning, you could, blow out your capital. So the easy way we think about it and trying to teach retail traders or investors is, you sell spreads, but you own contracts. So the idea is, if you're trying to generate, income or premium capture, if you're selling spreads, that's fine. But if you have some kind of hedge or insurance, that would be a net long contract. So, you sell, let's say, 5 spreads and buy 1 net contract for some sort of insurance or hedge. And I think that's kind of the general approach to risk management. You only want to lose spread dollars, but you want to be long net contract dollars. When volatility goes, parabolic, when VIX goes to 50 or 40 or does something really crazy, that one net long contract is worth a lot more than you think, because you don't have, people forget you have to adjust your volatility where it's currently trading, and double or triple where it is. So you go from like a 12 VIX or 14 VIX to 35, the positions P&L wise look totally different.
So one of your core principles then is to try to stay net long options inside a position from a risk perspective. Is that fair to say?
Correct. That is it.
You are singing, if I may say, I'm dancing here behind the microphone because you are singing my tune.
I figured as an old market maker, Joe, that's how you survive. You don't trade. You're not a market maker for 15 years, and you're short tons of net contracts. It could work for a while, but then the one day it doesn't, you're very, very sad.
Exactly right, and I think for our listeners, the beauty behind what Andrew's saying is it is very straightforward and simplistic. Net contract count. Are you long contracts or short contracts? As you said, if you're trying to take money out of the market, maybe you do it in a spread, but not in a net short contract way. So, outstanding, Andrew. How about each investor is different. How do you approach, each investor in terms of their needs for risk management?
Well, what we try to do is make sure we have kind of an overarching, like risk policy, or the way we manage. It's only as a percentage of capital, meaning, if you're going to trade options, you have to be realistic with yourself. You really shouldn't use, at least I think, if you're going to just trade like a pure option portfolio, you shouldn't use more than 10% of your capital. And we don't like you to have, of that portion, not more than 5% of real risk on any trade. So, part of risk management is just kind of managing the dollars. You're looking for edge in trades, but I think the biggest problem is people just go in too big too early with a particular idea because they think it works or they read it somewhere. And this strategy over time works, but they never have enough money in cash, especially when the market is doing really crazy things, when there's actual real edge. So the biggest thing that's kind of the one size fits all idea is making sure that whatever you do is relative to capital. And the easiest way I think of that is on a percentage basis. So you're never doing anything that's going to put your dollars at risk, right? You're always trying to make some money, right? So we're more of a single, double, triple, base hit type of education firm than like the home run education firm. And the only way really you make home runs is if you generally net long some sort of contracts and then just something off the curve happens. So that's more a factor of just luck and position, and not really, I think this stock is going to do something. So those, again, that's all ways you can make money, but we do the kind of, like I said, the one size fits all for risk management is really just position sizing relative to capital, and you got to keep those ratios, what I would just say, moderate.
Makes a lot of sense. Slow and steady, hitting those singles and doubles. Again, love that philosophy. You early on talked about volatility trading, and that actually sounds to be one of the core focuses for Options Pit. For listeners out there who really aren't familiar with volatility trading, and of course, every option trade is a volatility trade. Talk to our listeners a little bit about your approach to volatility.
So we look at volatility as a tradable asset. So if you go sort of to your options 101, you learn about what Vega is, and Vega is the sensitivity of an option to a change in the underlying volatility. And that, if you learn how to structure positions, that's a tradable thing. So with the SIBO introducing the VIX product, I don't know, was it 10 years ago now, they actually allowed you to trade VIX and volatility as a delta, meaning, what everybody's or most listeners are familiar with is you buy a call and want the stock to go up, that's a delta, right? And by sort of productizing volatility with the VIX, they've turned the Vega dollar into, a delta dollar basically. So if I think the volatility in the market's going up, you can trade the VIX, or you can trade the volatility products. You could trade Vega directly without actually having to worry about the messiness of where the underlying's going, right? So the market can go up and down, but volatility can actually trade sort of in its own direction. So you can make pure bets on volatility on the indexes, on equities, by the way you structure positions, or you can just go to the volatility products or the volatility futures and trade, volatility going up or down. Like today, VIX is probably down $0.50 maybe. The last time I looked, it's now down 41 cents, even with the market down, which generally is a pretty bearish sign for volatility, with stocks down and volatility down. So you can bet on the volatility of the market. You could trade the volatility of the market. You could also use it as a hedge. And you could also trade the volatility of an underlying product by how you structure, a butterfly and iron condor, or you sell some spreads here and there. There's all kinds of different ways to do it. But that is what I think of when I think of trading volatility. You're looking at changes in underlying volatility. And since vol reverts, mean reverts, it is, I think, over time, a little bit more dependable way of trading option premium.
And for the listeners who may not be familiar with quantifying that Vega risk, how do you do that for them?
Well, we pull up some platforms. We use LiveVol a lot, actually, not to plug them, but it's a pretty solid platform. A lot of other commercial platforms have volatility in there, or Vega as a number. So what we do is we teach them how to break down what it is. So generally, like a 1-point move in volatility is how you define a change in Vega. So if you're long 100 Vega and the underlying volatility moves up a point, you should make $100. That's the basic way. So what we do is we break it down by term structure, by vertical spread for skew horizontally, and then we also teach them about realized volatility. We call it kind of like the 3D market curve for volatility. So people literally can understand where the volatility is driving the option contract. So once you're educated on how it works, then what you do is you can start to make some assumptions about it. Meaning, it's silly to tell somebody, I know where something is going to trade tomorrow, right? Because if you knew that, then you would have $1 trillion and it would all be over. What we can do, though, is by using volatility in an intelligent way, we can structure trades that give you a range of motion, basically. Well, as long as a stock statistically stays in this area, we would expect to make X dollars. So that's more of the type of trading that we look at. And volatility specifically plays a role in it because of the reversion, meaning when implied vol is really high, it generally doesn't stay there forever. And when implied volatility is very low, it doesn't stay there for either. So you can structure positions to kind of take advantage of those things. So, and that's what we do. And that's just part of, probably, Joe, when you were a kid many years ago, you kind of went through the basic volatility training. And that's something I learned when I first started. And that's what we impart to our clients, who are generally fairly sophisticated professionals that are trading sizable portfolios, and they want to understand how to trade and how to structure positions and how to hedge, and at least read some volatility trends. So when VIX is going up, they want to make sure they're not in the way of it, and they want to make sure the position structures they have are going to perform right.
Well, volatility is such an important component of the option space. I mean, I think the month of May, we're going to focus on volatility. I may have to have you back, because I could sit here and talk to you about vol for the next 2 days. But, in the context of risk management, talk to me, if you would, about some of the downside strategy plays that you like. Risk management, downside, what do you like?
So as far as putting on an opening position, the best downside play usually is you just buy puts.
That's easy.
The second part is how you try to finance the put. So
That might be the first part.
Right. So what we do is we try to finance those positions. You learn about, there's time spreads, trying to create sort of theta positive or decay positive. You try to create theta positive positions that can help finance a put or two puts for a particular position. So generally that's kind of what we look at for trades. Or when there's a lot of skew in the market, we look at butterflies, because generally once, because of the kind of the curve and the downside puts, butterflies are relatively cheap, like put butterflies, buy one, sell two, buy one. There's a lot of different ways to structure, but that's this kind of the second favorite way to do things.
If you would, just for those listeners who may not be too familiar with skew, could you define that?
Sure. Skew basically is it's the market's ability to adjust the Black-Scholes model, meaning Black-Scholes assumes a flat volatility, a flat annualized volatility. And, what we know is volatility when the market is falling tends to go up really fast. So the skew in the market basically means puts in the SPX or puts in an equity are always going to cost a little more than an at-the-money put, because of the fact that when volatility goes up and a stock goes down, it just explodes. So what the liquidity providers have done is they're going to price. We can go into more statistical answers to it, but basically they're just going to make those puts more expensive out of the money than they are at the money relatively. And what it does is it creates an opportunity because it makes certain types of positions actually very dollar cheap, meaning it doesn't cost a lot for a put butterfly. Like I could buy a put that has, a huge P&L potential if the market drops, let's say 20%. That doesn't happen very often, right? So that put, let's say, might cost me $2. Or I could spend 40 cents and buy a butterfly that gives me lots of downside protection, but doesn't cost me $2. It only costs 40 cents. 40 cents is a lot cheaper to finance than $2 is. So the idea is you're showing clients to look for downside hedge that is cost effective versus what they're trying to do. And just one of the ways is just teaching them, what skew is, when it's cheap, when it's relatively expensive, and then it changes the value of these certain types of positions. So what we did, again, that's what we just kind of spend a lot of time doing intraday and through our educational materials, is educating people on how the market prices from, let's say, the liquidity provider's point of view. And that's, I think, what we do kind of uniquely. We sort of put the retail trader in the liquidity provider's seat and say, okay, now you're here, how do you price this stuff? And once you kind of see how it's priced, it's easier to put positions on.
Well, Andrew, that's just, that's some good information that I think our listeners can take home. And you listeners, again, Andrew is at optionpit.com. His expertise is risk management. And by all means, if you want to reach out to him, please do. Andrew, anything else you'd like to mention to the listeners before we wrap it up?
Well, we'll see if this current bout of volatility is going to end. My guess closet idea about volatility is generally VIX only spikes. It needs really three things to happen, as just historically looking at it. So when you have a lot of macro events like currency devaluations and European banks falling apart and uncertainty about interest rates in the U.S., like when you add those things together, it makes the market a little more unstable over time or a period of time. So, and then of course we've had oil, going to zero, and that was also causing some potential destabilization in credit markets. So if some of these destabilizing things roll backward, that should reduce volatility, which is kind of what we're looking at today. So we'll just see if we'll see if the trend of, let's just say it, softening volatility continues as these sort of macro factors go away. So that's basically what I'm just looking at now.
Would you like to give us a specific date?
for when all this
no,
stuff.
I'm only teasing.
When all this stuff. If I know the date, that'll make it a lot easier because then I can shape a position on it. That's the problem. After the Fed got out of the market, or what they're trying to get out of the market, it used to be, the Fed was going to make these pronouncements on all these dates. And it made for a great vol trade because you knew that as soon as the announcement was over, the volatility would leak out of the market. And we had 2 years of that, and now it's gone. So it's kind of back to the old, there was no more telegraphing of dates. So the Fed was really nice to us with that. But now I believe it's not there anymore, and you got to find a new way to make money, I guess.
Either way, whether you come up with a date in the future or not, we will be sure to have you back. We appreciate your time today and your expertise with Strategy Spotlight, and we look forward to talking to you down the road.
Thanks, Joe. Have a good day.
It's time to meet the movers and shakers from the world of options. It's time for Profiles and Perspectives.
Joining us today on Profiles and Perspectives is Greg Stevens of Fidelity. He is a VP of Product Development there. Greg, thanks for joining us a lot today.
Yeah, thanks, Joe, for having me.
Before we get into some of the Fidelity offerings, why don't we get into a little bit of your story? Tell our listeners what brought you to finance and, what you've been doing for a while.
Yeah, sure, Joe. Well, it all really started back in high school with a field trip with my finance class to E.F. Hutton. For those in your audience who remember the brokerage firm, and for those who don't, they had a catchy slogan, right? When E.F. Hutton talks, people listen. Well, I listened and was hooked on investing after that. From there, I went on to Marion University in Indianapolis, where I majored in finance and business administration. Then I got my first job with Charles Schwab, spent some time there on their trading desk, and then really on to Fidelity Investments, where, as you mentioned, I'm currently vice president of product development, but I've held a few different hats here. Prior to this, I was in sales, or not sales, but a regional brokerage consultant for our phone sites. So been a long and twisting road for me to get here.
Well, it usually is. Very few of us have a straight line to where we currently are. And I just love the fact that for you, it was a field trip in high school. I mean, for our young listeners out there, take every opportunity possible to go on those field trips, whether it's finance or wherever you want to go. I love that, Greg. That's fantastic. So Fidelity, obviously, just wonderful firm, lots of offerings. Why don't you tell our listeners, some of the areas of investing that Fidelity is offering things for our listeners too?
Yeah, of course. Well, many of your listeners probably best know Fidelity as a retirement company who administers their 401k, or as an asset management firm with a wide range of mutual funds. But we also have a pretty well-regarded brokerage offering. And just to mention a couple of quick things, we were recently rated Best Overall Broker by IBD for the second year in a row. And it was announced this week that we actually have the #1 spot in the stockbroker.com survey. And as you mentioned, we do have a wide range of products for customers to choose from. Not only do can they invest in stocks, but there's 85 commission-free ETFs, that they can choose from. We also have fixed income products, precious metals, international trading, and many of your listeners may not know, but you can invest at Fidelity internationally in 25 different countries and 16 currencies. And of course, wouldn't be a well-rounded offering without having options available to you as well. They can trade them in both their brokerage and retirement accounts here.
Now we're talking, zeroing in on the option space. And you mentioned all those different offerings. Are you running each of those operations, Greg? You said you wear a lot of hats.
Do wear a lot of hats and do have some don't necessarily have my hat in all of those areas, but we're a closely knit group, and so we do we do discuss the different products pretty regularly at this point. But my primary focus, Joe, as you know, is on the option space.
I do indeed, and I just thought I'd tease you a little bit there. Why don't we focus on that option space? Why don't you tell our listeners, how you approach options, some of the tools that are offered? Go for it.
Yeah, no, it's a great question, Joe. Here at Fidelity, we believe that our customers deserve to have a well-rounded options offering that supports how they want to trade options. So we believe it's important to give them choices. That's why we have experienced reps in our active trader services group who are option principals to answer even their most difficult questions. If they need to go in to a little bit more in-depth discussions, we have our strategy desk, so they can always contact a person to talk through their investing strategy or questions that they may have. We also, from a platform perspective, it is truly trade your way. For customers on the go, they can use our mobile app with access to both single and multi-leg options as well as new services. In Fidelity.com, we have a wide range of research and analysis tools, not only for options, but equities and all those other products that I mentioned. And finally, we do have a thick desktop or an active trader application. It's called Active Trader Pro, which is for the more active customers who make their own investing decisions and are constantly monitoring and trading in the markets. And as I mentioned, or maybe I didn't mention, we have some pretty reasonable rates for our customers as well.
It's a good combination. Let me back up a little bit. You mentioned active trader services, I guess, on the help desk as well as the strategy desk. Would you go through that just one more time, just so our listeners are clear of some of the support that you offer?
Yeah, sure, Joe. Yeah, in active trader services and on our strategy desk, we have seasoned professionals who are very well versed in options, and not only options, but the markets in general, whether it's stocks or bonds or ETFs. They can answer pretty much every question that our customers may come up with, and if they don't, they know where to go to get that additional information. But we find that many of our customers, while they have their own idea, they like to have some validation, or they'd like to talk through what's going on in the marketplace. So we have access, to these trading professionals during market hours, as well as 24 hours, 7 days a week access to investing professionals to answer the questions even at the latest of hours, Joe.
Well, that's fantastic, Greg, because as you know, and as I know, I haven't been down on the floor a long time. Whether you are experienced in the option space or just getting started, things come up, things change, and even the most experienced investor can oftentimes have questions. So, to have that online support there where somebody can really help you go through a particular issue is got to be, really an important offering that you guys bring to the table.
Yeah, as we get a little more automated, sometimes the in-person discussions are left to the side, but we try to make sure that we maintain and have that access for our customers.
Talk to me a little bit about the Active Trader Pro. Is that available to each of the customers? Is that a higher level? What about that?
So Active Trader Pro is available to anyone who trades 3 or more times on average within a month. So the application itself it really is something for those who are monitoring and trading the markets throughout the day. They can customize their trade experience and really trade the way that they want. We have suite of tools and products not only for options but for equities as well. But on the options fronts, we have probability, P&L calculators, idea generation tools, for example, option filters. We also have an interesting tool called Strategy Ideas, which displays the best performing strike for the 30, 60, and 180 time frames for cover calls and cash secured puts over the last 2 years. So it's a study to try to help our investors decide, if I'm going to implement this strategy, what is the best strike, or what are some of the results that they can get in order to make their trading decision. Customers can direct, both single and multi-leg options to the exchange of their choice, or, as always, let Fidelity, do the work for you with our intelligent order routers. So, a lot of good tools and features within the application.
Indeed, and some of those tools for the investor who's just starting in options. Do you have advice as to, or at least an approach that you think is best inside of the Fidelity offerings?
Yeah, I sure do, Joe. Not only do we have the reps, that a customer can call and ask their questions, we also really have a pretty diverse education offering as well. And it's for the novice, and as you'd mentioned, even the more advanced traders always have some questions about what's going on, not only with our products and tools, but with some new strategies maybe they're looking at. So within our Learning Center, for those who aren't familiar, it's Fidelity.com. And you can go into research and then the Learning Center. We have, short product and tool demos. We also do webinars, as well as online courses. And I think that the online courses really offer our customers a unique way to customize the learning experience, to themselves. So we break down many complex subjects into smaller, more consumable pieces. We know time is it's precious to everyone, and finding that time to sit down for an hour or 2 hours maybe isn't the easiest of things to do. But we chunk these out into more consumable pieces where it's really learn at your own pace with what fits in your schedule. So you can complete one lesson and then move on to the next while we keep track of your progress for you. And then once in these courses, are everything from product and tool demos to investing strategies like cover calls. But I think that's a good place to start, as well as for those on the call who are obviously interested in trading options. We have 3 tracks for webinars that we really do on a monthly basis. One is for basic, those just getting started. We find that many of our customers are interested in options, but as you mentioned, how do I get started? So that's a good webinar series for them. We also have a little bit more of an advanced track, which goes into everything from Greeks to more complex strategies like iron condors, or even we've done some discussion on delta neutral trading if we want to go real advanced. And then one that I really like is one that you participated in as well, as an expert options series. So we have industry professionals like yourself who come in and give 1-hour webinars on topics that are timely and relevant within the marketplace. So I think, Joe, from the courses to the webinars to our tool and product demos, we have a pretty good offering. And in the Learning Center, we'll help you get started, based on how you assess yourself from beginner to intermediate to advanced, and suggest a course schedule for you.
Outstanding, Greg. You really laid that out well. And listeners, as you heard Greg, explain very succinctly, whether you're just getting started or far more advanced, there are all kinds of free tools and educational offerings at Fidelity.com. So, Greg, anything else you'd like to, mention before we wrap up? I think you did a really fine job laying out the offerings there at Fidelity.
Yeah, Joe. I think that we covered quite a bit of information there, and we would welcome any of your listeners to visit us on Fidelity.com. The Learning Center information or the education resources are free. You just have to sign up and get started, so you don't even have to have an account with us. But we're excited to get the offer to come and speak with your followers, and appreciate the time, Joe.
Well, Greg, always good to talk to you. Thanks for joining us today. And listeners, remember that's Fidelity.com, and especially the Learning Center. Greg, thanks again.
Thanks, Joe.
It's time to upgrade your options toolbox with cutting-edge trading platforms, devices, and information. It's time for tools, resources, and good reads.
In today's tools, resources, and good reads, we'll start with a brief discussion of moving averages. As a longtime trader who frequently used charts, I often relied on moving averages as a basis to formulate an opinion on the underlying. For many, moving averages help in identifying the trend of the underlying. The 2 most popular types of moving averages are the simple moving average, which treats each unit in the average equally, and the exponential moving average, which gives more weight to recent prices. Popular longer-term moving averages are the 50 and 200-day. Both are worth keeping an eye on. Shorter-term averages come in lots of different measures. I personally like the 17-day average, but others prefer a 10 or 21-day moving average. Day traders often use moving averages with much shorter time frames. One important aspect of moving averages that I think is often overlooked is the distance above and below your favorite average where your underlying is trading. These distances can equate to other tools like trading bands. Many of you may be familiar with the Bollinger Trading Band. These distances above and below the moving average define those bands, and whether you use the bands or not, I would suggest keeping a close eye on those distances. Extreme levels above and below your favorite average can be a good point to initiate or reduce positions. If you're not currently looking at moving averages, give them a try and consider the three I mentioned, either the 17 or 21 day, the 50, and the 200 day. Today's resource we'd like you to focus on is a website which offers many of the same pieces of information we offer at optionseducation.org. The site is the Options Profit Calculator. You'll find it at optionsprofitcalculator.com. Covered calls, spreads, along with other more advanced option positions are analyzed. Check it out. Finally, our good read for today is a fine piece authored by Russell Rhodes of the Chicago Board Options Institute. His book's entitled Option Spread Trading, a comprehensive guide to strategies and tactics. Whether you're new to options or more advanced, spread trading makes a lot of sense. Russell's book will definitely help. Give it a try. That's it for today's tools, resources, and good reads.
It's time for a nostalgia break. It's time to take a look back.
In this month's Looking Back segment, I thought it might be interesting to focus on a couple of markets in the late 90s, the summer and fall of 1977 and 1998, since we're highlighting risk management as this month's OIC education theme. There sure was a need for portfolio risk management in both those markets, but I must say, looking back at the charts now, neither of those sell-offs looks like too big a deal. I remember it very differently, though, being on the floor of the Philadelphia Options Exchange, embraced with fear, wondering what the heck was next. Basically, the financial Asian crisis was a combination of fast money, changing currency rates, and slowing economies all wrapped up in one. The U.S. markets in Dow terms in 1997 sold off almost 15% in a couple of months, from around 8,200 to about 7,000. Maybe that's why I was nervous on the floor, even though I was generally a long gamma trader. Puts were certainly your friend, and long ratio put spreads or back spreads were great ways to trade those markets. Now again, the Asian financial crisis started in Thailand in the spring of 97, but spread quickly to neighboring Asian countries by the fall with devalued currencies across the region. On October 27, 1997, the Dow dropped 554 points, its biggest point loss ever. That was October 27, 1997. By the spring of 98, the financial unrest had spread. On March 23, 1998, President Boris Yeltsin of Russia abruptly fired his entire cabinet, and in May of that year, Russia's central bank raised interest rates 150% to avert a collapse in its currency, the ruble. China, Japan, and South America were next as the crisis spread. The currencies and markets both under pressure. Throughout the summer of 98, the World Bank and IMF tried to offer support to fledgling countries and currencies, but to little avail. On August 31st, 1998, the Dow dropped another 512 points, its second largest point loss ever. Now, while all this financial turmoil was spreading across the globe, a U.S. firm by the name of Long-Term Capital Management, one of the largest U.S. hedge funds, was imploding to the point where many thought its demise could further worsen the panic in financial markets. It got so bad that on September 23rd, 1998, pushed by the New York Fed, a consortium of leading U.S. financial institutions provided a $3.5 billion bailout of long-term capital. I can't get into all the details of long-term capital here, but let me mention two things. First, as it relates to options and keeping it simple, sizable net short option positions can kill. When markets crash, liquidity often dries up and short, out-of-the-money options blow up in price and allow little ability to hedge or cover a position. My understanding of, on a very macro level, is that's what happened to long-term capital. The other point, that is, if you are interested in this story, pick up The Rise and Fall of Long-Term Capital, an excellent book by Roger Lowenstein. The markets continued to be volatile in this period, with the Dow briefly trading as low as 7,300 early in the fall of 98. Volatility was a constant back then. Does that sound familiar? So with the U.S. cutting rates 3 times in the fall of 98, and by the way, the third cut took the 30-year bond rate to below 5%. 5% for the first time in 30 years. You had the IMF, the World Bank, all doing their best to assist countries and currencies across the globe. But despite all the unrest, on March 29th of 1999, the Dow closed above 10,000 for the first time in history. Volatile times indeed, a great time to be long options and long gamma. That's today's Looking Back. Thanks for joining us.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of The Wide World of Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions@theoptionsinsider.com.